And essentially what they're doing is they're lending cash against the invoices as collateral. So it's kind of, you could think about it as almost like a secured commercial paper, right? It's short-term financing. It just goes by this, industry term, trade finance. So what it amounts to is your invoice. Let's say it's for $100. These things would get marked up and priced at about $70 interest rate. So essentially, um, First Brands was funding itself through short-term arrangements where it was paying as high as like 30%, in terms of a discount yield against its invoiced revenue. So highly risky, an extremely onerous interest rate. A lot of smart capital realized this was not sustainable for the company and didn't buy the debt. There's a lot of dumb money out there, from money managers who didn't necessarily do the due diligence, and they're on the hook now for losses. So you can read the stories for yourselves, but I think the ones that come to top of the list, and that's in the little bullet points here at the summary from Bloomberg AI: Jefferies, UBS, and Millennium look like they're potentially on the hook for over 10 billion in losses. Some of the collateral was pledged multiple times, um, which means recovery rates would be low. There's this firm Rystone, which has some management overlap with the Greensill kind of fiasco that showed up in the kind of the sequence of deals that Credit Suisse was involved in that led to its demise. Back, I'm talking about the late 2010s, early 2020s era. We saw what happened with Credit Suisse, with the government, Swiss government kind of rescue plan, tuck it into UBS. Now you're seeing UBS having to own some of these credit losses on a deal that's, from a personnel standpoint, there is some overlap in the financing partners with kind of the same names who were infamously tied in the business deals with Credit Suisse. I think that's all we can say. At this point of this, it's a situation that'll gradually work out. There will be losses. You're seeing some funds who had really significant exposures here. Those investors, whoever the capital was behind it, there will be losses. I saw one headline: BlackRock was trying to get out of one of those, like make a redemption request. We'll see how that goes. But this isn't one of those things that just shows up out of nowhere. It was actually the tariffs and the Liberation Day and all of these processes that have been building up over the course of the year. And now the bodies are coming to light. So this is kind of like, bring to mind the quote that describes this as Warren Buffett. In the bull market, everybody's fine. Like, the music's still playing, so there's no rush. Like, we're not going to find out who's left holding the bag, who's going to be left holding the losses. But this quote from Warren Buffett: "You don't find out who's been swimming naked until the tide goes out." Well, the tide's clearly coming out now. Liberation Day was the forcing function to that effect, and now we're starting to see the bodies come to the surface, and this is one of them. You can say the same thing about other kind of credit issuers, ABS originator like Tricolor, for different reasons, but similar Trump administration policies that are driving it. In the case of Tricolor, which was heavily involved in subprime auto lending, loose documentation, loose collateral, tracking. Like, in some cases, there was, again, as we saw with First Brands, a problem with collateral rehypothecation, pledging the same asset behind multiple credits, and the system not having, like the financial system, the banks lending into it, not doing the due diligence to making sure they had clear title to assets, all of that stuff, and unencumbered claims, no other creditor, all that.